Most traders go long by buying shares or calls, tying up 3 times more capital than necessary. But there's a smarter way called zebras. I've been trading professionally since 2018 and I made over 100K with this strategy alone. Today, I'll teach you how to trade zebras. You'll never go long the same way again. The zebra strategy is a directional stock replacement strategy that delivers 100 delta exposure, but at a fraction of the cost. There's limited downside, unlimited upside, and minimal theta decay. This works on any instrument like on SPX, QQQ, Tesla, your favorite stock, whatsoever across any time frame. So what is a zebra? It's actually an acronym. It stands for Zero Extrinsic Back Ratio. It's a leveraged position that's mimicking 100 shares of stock by having 100 delta. It has full stock equivalent directional exposure. There's no extrinsic value in this trade, so there's no premium paid. Although you get leverage, you don't need to pay any premium. And because there's no premium, there's no theta decay, which is very favorable for us. It's very flexible. You can be bullish and bearish with this trade. You can do it on any instrument as long as there's an option chain on it. And also you can do it for any time frame. You can do it for, say, a 2 weeks trade. You can do it for a 6 months trade, 1 year trade, 2 year trade. It's up to you. You can treat it like a leap too. Also, it's highly leveraged. So you're controlling 100 shares of stock at a fraction of the cost. I'll show you a table of the comparison of the various costs for different strategies of going long 100 delta or 100 shares. And you will see how capital efficient this strategy is. So before we get into how we structure this trade, I want to just do a quick refresher of a few terms that we need to know. Delta. Delta has a lot of meanings, but in this lesson, delta approximates the number of shares an option represents. So a 50 delta call is equivalent to 50 shares. The zebra is targeting a net delta of 100, which is equivalent to owning 100 shares. Extrinsic value, we also call this time value or premium. This portion of an option price decays over time. But with our zebras, it's structured to eliminate extrinsic value, so the theta decay doesn't erode our position. This is key. So let's talk about how we structure this trade. It's actually very simple. First, you pick your instrument. You have to make sure this instrument has an option chain on it. As long as it has options that are tradable and liquid, we can do this. And then you also have to have a direction bias, either bullish or bearish. If you're bullish, we have to buy 2 in the money call around the 70 to 75 delta range. Buy 2 of those, and then we sell 1 at the money call at 50 delta. Net delta will be 100. Why? Because 75 plus 75 is 150, and then we sell 1 at the money call, so we minus 50 deltas, so we get a net delta of 100. Now, if you want to go bearish or short, you do the same thing but on the put side. So you buy 2 in the money puts, 70 to 75 delta again, and then you sell 1 at the money put at 50 delta. The net delta will be minus 100. So why does this work? Why is there no extrinsic value in a zebra? Let me show you why. This is after market data, so the bid-ask spread and the extrinsic value might be a little bit off. But just to illustrate this, I chose 2 71 delta strikes. I buy 2 of them, and you can see the extrinsic right here, EXT, is 8.3. So 8.3 times 2 is 16.6. And then I sell 1 at the money 50 delta call. And the extrinsic value on that is 16.3. So you can see the net amount is actually just 24 cents. There's only 24 cents of extrinsic in this trade. That's very low. That's equal to nothing. So that's why this trade is really beautiful. There's no extrinsic value. We don't need to care about any theta decay at all. I'm comparing 3 different strategies to go long. All 3 of these strategies are controlling 100 shares of the stock or 100 delta. Tesla is trading at 381.5 right now. If we were to buy 100 shares of stock, it's going to cost us 38K, because 381 times 100 is 38K. We can also go long 100 shares by buying 2 at the money calls, 50 delta each, so that's going to be 100 delta. It's going to cost us 3,700. Pretty cheap, but there's a caveat to it. Most of that is extrinsic value, and the probability of profit is fairly low. Now we also have zebras right here. The cost is 4.5K to open this. Probability of profit is similar. It's exactly the same as 100 shares because it can only go up or down. In the case where the stock does not move at all, okay, so 0% movement, our zebras will not lose any money. Our 100 shares will also not lose any money. But if we were to go long 50 delta calls and the stock doesn't move, you're gonna lose this whole 3,700. This is a big X for me. I don't like this strategy at all. The next part is the beautiful part of zebras. Now, if the stock moves up 5%, if we own 100 shares, obviously we go up 5%. But the zebra actually goes up by 37% gain for a 5% move. Now, why is that? It's simply because the capital we use to open the zebra is only 4.5K. It's almost 8.5 times less than owning 100 shares. So the gain on this trade is approximately 8 times more. It's very leveraged. It's very capital efficient. And in a 10% move, obviously the stock goes up by 10%. Your position will go up by 10% if you own 100 shares. But your zebras will go up 75% gain because you're using so much less capital. You're using only 4.5K. Now, if we compare it with at the money calls, you can see even at a 10% move with leverage, you're going up 20% only. Zebra is the obvious winner in this case. Now, trade and risk management of this trade, it's crucial because this is a highly leveraged trade. So the first thing I want to talk about is we need to be closing this trade at 50 DTE. We do not hold it to expiry. If your zebra was open for 1 year long, you're going to close the zebra at 6 months. If you open this zebra for 2 years, you're going to be closing the zebra at 1 year. Vice versa, if you open this for 60 days, you're going to be closing this at the 30-day mark. This is to avoid the short leg expiring worthless. Okay, the next trade management tip I have for you with zebras is the rules of ×2 the time frame. So if you expect your trade to take 3 months long and you want to be in the trade for 3 months, then you open a 6-month zebra. If you plan to be in the trade for a year long, then you open a 2-year zebra. And the reason goes back to the first rule, closing at 50% of the days to expiry. You have to use a stop loss. Treat it like any other trade, as if you're trading with 100 shares of stock. You have to define your exit based on some technical analysis. Perhaps it's support and resistance breaches. Leverage will be amplified on both the gains and losses. So we cannot hold this till 0. You should not hold this to 0. You should not bag hold this. You need to stop out when your thesis no longer holds. And also you need to size responsibility. Risk only what you're willing to lose. Very obvious, but a lot of people don't do that. especially when they see the attractive returns on zebras, you have to be willing to lose the whole zebra trade. That should be your worst case scenario, and you should expect that, and you should put that into your sizing plan. Don't over leverage because of this powerful leverage strategy. Okay, let's go through some live examples. So I got NVDA open right here, and I'm looking at the 1 year options. I'm gonna look for the 75 delta, so approximately this one. I'm gonna buy 2 of them, and I'm gonna look for the at the money option, which is right now it's trading at exactly 200 almost. So I'm gonna sell one of those, and then make sure it's a sell and only one. I have to buy 2. There we go. This is how you structure your zebra. The delta you can see is it's not exactly 100 because right now this is after market data, so it's not live. The bid-ask spread is also not that nice. Yeah, right now it's 9:43 p.m. at night Eastern Standard Time, so I can't show you guys until tomorrow. What I want to highlight for you guys is the extrinsic. Look at this, only 17 cents of extrinsic in this trade. So you hold this for 359 days, you're not gonna have any theta decay. You're gonna decay at most 17 cents over a year. Totally worth it. There's no other trades out there that allows you to go long with so little premium cost. This is a no premium cost trade. Trade responsibly with this highly leveraged trade, because if you gain 31% with a 5% up move, it also means you can lose 35% with a 5% down move. Trade small, trade safe.